Good morning and welcome to the Killik podcast for Friday the 10th of July. It's been an extremely busy week with a huge amount of different moving parts, so we'll rattle through them all quite quickly today. So we've had the FOMC testimony, the UK budget, the Greek government table reforms, and the Chinese government looked to support their falling equity market. So on the FOMC meeting minutes, they remain data dependent, so we're seeing the improvement in labour market is slowing, which is a negative in raising rates. Equally, the trade-weighted dollar index has strengthened about 10% since the last meeting, so that will lower the appetite for raising rates, and oil's moving lower, which reduces the inflation pressure. So that probably makes a December rate rise more likely than September, and we continue to feel that rate rises will lag inflation in the US, which is probably good for markets. UK budget was again mixed for corporates. We've got a very business-friendly corporation tax rate cut, and the bank levy will come down and be replaced by an 8% profit tax. That probably puts a greater burden on the more profitable UK banks such as Lloyds. We have the scrapping of the higher rate tax relief for buy-to-let mortgages, and changes to the non-dom status, which will be negative for the housing market. We saw quite a big reaction to the house builders on the day of the budget, although they rallied subsequently. And today's liberalisation of the planning laws is good for house builders and also good for building merchants, which are less sensitive to political issues that the house builders are. We've also got a new national living wage, and that's a small negative for retail and hospitality industries. And finally, defence spending is set to rise to 2%, which is positive and unexpected, so good for stocks like BAE Systems. As for the last 2 weeks, Greek uncertainty continues. So this week we had Monday markets. We saw a good rally with the removal of Varoufakis, the Greek finance minister, who was making some pretty extreme statements about the ECB the previous week. Tuesday, markets sold off, however, because the new finance minister entered a make or break meeting with the EU finance ministers with no plan to present. Thursday, the market picked up as the Greek government, Tsipras, got their compromise proposals in, and that was largely agreeing to what was on the table pre the referendum that the Greek population obviously voted against. So that's VAT and pension reform in exchange for debt relief. The ECB for us remains the key instrument in protecting markets, regardless of what happens on Sunday, and that's the sort of probably the final deadline for this saga, which has now gone on for a long time. And they're there to block the transmission mechanism of any sort of default in Greece into the wider European economy. And that will happen through peripheral bond yields. And what the ECB have made very clear is that they're to step up the rhetoric in order to say that it will protect the rest of Europe, to front load QE purchases to keep those bond yields down. And we think that given the scale of the bond issuance in the market, the ECB to date has bought 2.5 times the net supply of sovereign bonds in Europe, that they are able to contain this contagion. And the ability in terms of their weapons in the debt market considerably higher than the US in QE3 when they were buying around 0.5 times the net sovereign debt issuance in the US. The bigger risk for us, which is becoming more and more clear, and why the ECB have played and the EU have played such a hardball game, is that we've got an election in Spain in November, and this economy is far bigger than the Greek economy. You've got a 1.1 trillion euro economy against 150 billion in Greece. They've got an unemployment rate of 23%, but they've also got a popular radical left-wing party in Podemos and a very popular Pablo Iglesias, who gets 20% of the opinion poll vote. So clearly they don't want to be seen to opening the door to radical left parties in sort of periods where they want to maintain the austerity programs. For us also, just looking at the MSCI, we do feel that this market is increasingly attractive as we move out of this period of political uncertainty. As you can see here, the dividend yield on the MSCI, which is around 3.5%, is at a substantial premium to the bund yields there. So that equity risk premium argument that's worked so well in the US is very much in play, particularly if you feel that the ECB will be able to keep rates yields lower for longer, which is clearly their intention. We're also seeing growth starting to pick up in the EU and money supply expanding quite rapidly, and that tends to be a very good precursor for growth in GDP. And as you can see here, that's starting to come through. Equally, margins are expected to expand from the very low levels they are at the moment. And what's really important is capacity constraints in the labour market and in the capex stock within the EU remain a long way off points where we'd probably see inflation coming through. So that's all very positive for that market. Clearly here we've got the recent market performance. This goes back to April, and as you can see here, the MSCI Europe is down about 8% versus the S&P down 2%, and Japan's largely been flat. So FTSE somewhere in the middle there. But we feel that any sort of resolution will present a reasonable buying opportunity in order to increase European weightings in portfolios. Perhaps even more concerning than what's been going on in Greece has been the chaos in Chinese indices this week and the reaction from the Chinese government. So currently in China, across the equity markets, around half the constituents are suspended, so not trading, in an effort to stop the slide in their share prices. Management have been banned from selling for 6 months, so there's some very draconian restraints on that market. What should be a free market clearly isn't. What they've announced last night was the China Securities Finance Corporation is essentially a body that's backed by the People's Bank of China, have said they will provide abundant funding for the equity market and for purchases of shares. So that's seen quite a big bounce in the Shanghai Composite. The strange thing is that the bounce in the stocks that are still listed has been far, in a way, in excess of the bounce in the market, and that's because of all the suspended shares. So we continue to expect more easing in China, continue to expect them to try and stabilise that growth rate, which is continuing to deteriorate, and address the low inflation rates that are coming through there, which is very important for the global economy. So the week ahead will be extremely busy. So the Q2 US results season really has kicked off in earnest. So we've got a lot of banks, Wells Fargo in the US. We've also got Johnson & Johnson, Yum Brands of the Killik stocks, JP Morgan there as an important one on Tuesday. On Wednesday, we'll be looking at BlackRock, Delta, Bank of America, Netflix, all with interest. Thursday, eBay, Goldman Sachs, Google of the Killik stocks will be important to watch. So just looking at Wells Fargo, net interest margins we continue to expect to expand. We're looking for loan growth to be strong given the recovery in consumer confidence in the housing market, declining bad debts and regulatory fines, certainly in terms of the pace of the increase anyway. On Google, we continue to be slightly more nervous about the cost per click pressure that's coming through, but we will be looking for stronger guidance on operating expenditure, so splitting out what's maintenance capex and what's investment capex. Also a little bit more on the strategic assets and the value of YouTube and their mobile search. And finally, a little bit more guidance on capital returns. So we feel that they've got 64 billion of cash on the balance sheet. Some sort of buyback program could very easily start accelerating earnings per share there. So, and equally, more disclosure has the potential to raise the PE on the group, and we saw that with Amazon when they decided to split out the two divisions, Amazon Web Services and the retail division. We got an uplift in the PE. So there's plenty of levers to pull for Google, and we hope to see some of them next week. Also, Goldman Sachs, this is a fairly recent buy note. Again, we are looking for expense ratio improvements that will improve the operational gearing of the business, continuing to see M&A improvements. We've seen a solid pipeline, and Q2 was obviously very strong against Q1. We're also looking for the opportunity to increase the historically low leverage. One of the reasons why we like the stock at the moment is the leverage is very low, and a 1% increase in that leverage would add a percentage point onto return on equity. Clearly evidence that they're growing market share, especially in Europe, from the retail banks that are withdrawing, and the sensitivity to higher rates, and because higher rates will increase volatility, which will increase trading, both in fixed income and volatility products, as well as higher returns on their money market assets that are sitting on the balance sheet earning very little. So all of those sort of potential increases to the profitability of the business on a valuation of 11 times 2016 and a 10% return on equity, which is a trough multiple, continue to make us feel this is an attractive stock to buy. So that's it from me. Thanks very much. Have a good weekend.